Hi, my name is Paul, and welcome to month number 4 of my $100 per month Canadian stock portfolio series. On this episode, I'm going to be going over Knight Therapeutics' annual earnings report and their webcast, and I'll also be explaining my reasoning for not holding any cash within the portfolio. I'll also be covering how the portfolio has performed over the last month, with comparisons against the benchmarks, and of course I will be showing you how I invest this month's $100 as well. So for the sake of keeping this video a bit on the shorter side, I'm going to skip past the goals and rules just because they've already been outlined multiple times in previous episodes. But if you do want to see the goals and rules I've set for the series, then there is a document in the description of the video that explains everything in detail. With that said, let's quickly go over a brief recap of the companies that I hold in the portfolio. The largest holding is the Morguard North American Residential REIT, ticker symbol MRG on the Toronto Stock Exchange, which is one of 3 Morguards on the exchange, so make sure you're looking at the right one, with the ticker MRG. Morguard owns residential apartment units within cities and large suburbs throughout the US and Canada. I've been investing in this security because I believe it's trading at a large discount on multiple different metrics when compared to its peers, and it's also trading well below its net asset value. Last month, I invested over 78% of the $100 monthly contribution into Morguard because it's my strongest conviction in the market. The next business that I've been purchasing shares of in the account is Knight Therapeutics with the ticker GUD, again on the Toronto Stock Exchange. Knight is a specialized pharmaceutical company that predominantly operates throughout Latin America by licensing, marketing, and distributing drugs. The decision to invest in Knight Therapeutics is centered around a special situation involving a historically successful management team that specializes in acquiring undervalued pharmaceutical drugs and growing them much larger. Part of the investment theory here also involves Knight's loans that give the company exclusive rights to purchase, market, and distribute successful products developed by the borrowing biopharma companies. Last month, I spent a little under $11 of the $100 purchasing shares of Knight Therapeutics. The last security that I hold shares of in the portfolio is MTY Food Group, ticker symbol MTY, which also trades on the TSX. MTY operates and franchises fast food, casual dining, and other specialty restaurants, in addition to selling and distributing food products within the US and Canada, and it has a small but growing footprint internationally. Like Knight Therapeutics, MTY has founder-led guidance that has created a history of high-quality, profitable acquisitions. MTY's restaurants like Cold Stone Creamery, Baja Fresh, Papa Murphy's, and Thai Express, alongside the 80 or so others, have made the company into one of the fastest long-term EPS growers in the restaurant industry. MTY's premium growth, however, trades at a lower earnings multiple than many of its slower-growing competition, even though the company also offers a stronger dividend. This is why last month I decided to invest just under 11% of the $100 that I contributed to the account into MTY. Now, if you want a more in-depth breakdown of my reasoning behind these investments, then I'd recommend you go back and watch episode 1 and 2 of this series where I discuss them in more detail. I'll have a link in the description to the monthly portfolio playlist which contains every episode in order. Now, let's see what happened with each of these companies over the last month, starting with Morguard, who, aside from declaring their usual monthly dividend, also announced that they will be releasing their Q1 earnings report on April 26th, and that they'll have their conference call on the 28th. As far as news goes, that was about it for the Morguard Residential REIT, and news for MTY Food Group was much the same. The only thing of note was that their first quarter earnings report will be released before the conference call, which will be on April 8th. Knight Therapeutics, on the other hand, had quite a bit of information to go over since they released their fourth quarter and year-end results. Firstly, revenues for the full year finished up 22% over 2020's. Most of this increase in revenues was noted as being attributable to the acquisition of Exelon as well as incremental demand increase for infectious disease products brought on by the pandemic. Fourth quarter specific revenues were up only 6% over the previous year's Q4 when adjusting for exchange rate fluctuations. This quarterly revenue weakness was noted as being largely influenced by advanced purchases in Q2 and Q3 of infectious disease products, which reduced demand in Q4. So it looks like normal seasonality of the business continues to be impacted by COVID, but it was stated on the conference call that more normal purchasing patterns are expected to return over the coming year or so. The next piece of information that I want to highlight is that the company's gross margins have been expanding over the full year, from 41% in 2020 up to 47% in 2021, and Q4's gross margin was 48%, up from 36% in Q4 of 2020. Also noted in both the report and the call was that if not for hyperinflation, then both the quarterly and full year gross margins would have exceeded 50%. That said, net income was down about 50% for the full year and was also down when comparing Q4 of this year to Q4 of 2020. This seems to have been caused by the requirement to pay more in taxes because of deferments in the prior year, as well as having to compare against stronger unrealized gains on Knight's investment assets in 2020. Also, on the full year, there was an increase in one-time expenses from the acquisition of Exelon and related transaction costs, which helped to contribute to the lower net income. As for guidance, Knight is projecting revenues to increase between 6.5 and 8.5% over the next year, which sounds pretty reasonable to me. Now, not much of the information that I've just talked about particularly affects my investment conviction into Knight. It's nice that the company's margins are expanding, but I'm not really buying the company because I expect insane revenue growth or consistent earnings growth. The reason I'm buying Knight is because I believe that the management is composed of great acquirers that have a successful and conservative business model, and they stick to it. So what will really affect my investment conviction into Knight Therapeutics is if the company is able to stick to their strategy. Part of this strategy involves holding a fair amount of cash to keep the company able to pay for acquisitions and avoid relying on the usage of debt. If we look at the balance sheet, we can see that the cash pile did decrease by about 10 million, but the company used over 15 million on repurchasing shares for cancellation within the quarter, at a level that I believe is still discounted. On top of that, the company also repurchased an additional roughly $5 million worth in shares since the recording of the annual results. So it is possible and probably even likely that the cash pile will be lower next quarter as well, which is fine by me so long as the capital is being allocated sensibly. Next, I want to make sure that the debt isn't increasing too rapidly without good reason. There weren't any new acquisitions within the quarter, so I'd expect the debt to have either remained fairly flat or decreased, and that's exactly what happened. Both the total and current liabilities decreased during the quarter, so that checks out. The next thing that I want to check on is the tangible book value. Knight repurchased shares and reported a loss in the quarter, so I'm not expecting an increase here, but the loss reported was relatively small compared to the previous quarter's tangible net asset value. So I'd expect a small decline, and that's exactly what we got. So again, checks out. The last thing that I want to cover is some of the guidance that was given. Firstly, on the webcast, the CEO said that they're still looking for more acquisition opportunities and growing the portfolio, which is exactly what I wanted to hear. On top of that, mentioned in the annual report was that there are no dividends expected in the near future, which also sounds good to me since the company isn't consecutively profitable on a quarterly basis, and I think that the money is currently better spent repurchasing shares or growing the business. Honestly, this earnings report didn't really change my long-term outlook for the business one way or the other. But the share price did react with a nice little dip, so I'm sure that the company got to repurchase some shares at a nice price, and hopefully I'll get to do the same with my own capital later on in the video when I get to buying shares. But before we get into any of that, let's first break down the monthly performance of each security and the overall portfolio. Starting with Morguard, last month I bought 4 shares for $19.63 each. And over the course of the month, these shares declined by 0.1% to $19.61 before accounting for the dividend that was paid. When including the dividend of 5.83 cents per share, this turns Morguard's loss into a gain of 0.2% over the month. Next is Knight Therapeutics. I bought 2 shares of the company at $5.42 each, and over the course of the month, the share price dropped by about 3.7%, ending the month at $5.22 per share. Last, and this time certainly not least, was MTY Food Group, which was purchased at the beginning of the month for a share price of $49.14. At the end of the month, MTY's share price was up nearly 10.9% for a closing price of $54.49 on March 31st. At the end of the month, the portfolio managed to eke out a small gain of 0.69% on the $100 contribution and 23 cents in dividends that were reinvested. Currently, the portfolio sits at $311.56 on capital of $300 that was contributed and 23 cents of dividends that were reinvested. This puts the portfolio's total unrealized gain at 3.78%. Now, let's compare this to the 4 ETF benchmarks. This month, the public portfolio had its first month of underperformance against the S&P 500 index, VFV, which, when accounting for the dividend that was paid for holding VFV, the index outperformed my portfolio by 3%. The monthly public portfolio also underperformed the rest of the benchmark ETFs for this month, underperforming the Canadian All-Cap ETF, ticker VCN, which beat me by 1.13%. The Global Value ETF, with the ticker symbol VVL, was the next best performer, coming out 1.1% ahead of me. And the worst performing index of this month was the Canadian Large Cap ETF, ticker symbol VCE, which also outperformed me by 0.87%. Since inception, which now has been about one full quarter, if I had invested $100 per month into each of these indexes as well as my own portfolio, the results would have been as follows. The worst performer would be the Global Value Index, which would be worth only $298.08 for a loss of 0.64% over this period. Next would have been the S&P 500 portfolio, which would be worth $299.45, representing a 0.18% loss. Next, the Canadian Large Cap portfolio would be worth $307.46, representing a gain of 2.49%, and the Canadian All Cap portfolio would be worth $308.12, representing a gain of 2.71%. After the end of this first quarter, the public portfolio has a value of $311.56, giving it a 3.78% gain. This means that despite my poorer performance this month, the ETF benchmarks are still lagging behind my portfolio after the 3-month investing period, lagging by a range of 1.11% to 4.33%. That said, we're still in the early days of this portfolio, so I wouldn't go attributing this outperformance to anything other than sheer luck as of yet. Alright, now it's time for me to choose how I want to invest this month's $100 as well as the 47 cents in dividends, courtesy of Morguard. There aren't really any new companies that I'm looking to add to the portfolio that I can afford to buy at least, and I definitely do want this month's money to be invested, and the valuations of the businesses that I have been buying haven't really changed much, nor have my opinions on them, so I'm just going to go ahead and invest exactly how I did last month by buying 4 shares of Morguard, 2 shares of Knight, and the remainder will go into a fraction of an MTY share. So let's cut ahead and see how much I get for this month's capital. Alright, so we're back in the account and we have exactly $100.47 to spend. Let's first start off with Morguard. So we're going to buy our 4 shares and it looks like the current price is $19.78. So we will just buy it at the market. And let's check to make sure that went through. It did, and we got them at $19.78 each for a total price of $79.12. All right, that leaves us with $21.35 left. Knight shares are trading at about $5.19, so we'll buy 2, and the remaining money we can spend on MTY shares. So let's get this done. And it did come in, and we got them for $5.20 each. All right, now I'm going to do my fractional buy of MTY, and it looks like we have $10.95 left over, so let's do that. And we should get about 0.2 shares. So, like usual, this one's not going to be filled until later on in the day. So it is pending, and usually it gets filled at 3 o'clock, so I'll be back around that time. It'll just be a second for you guys though. Okay, so I'm back a little bit later on in the afternoon now, and I have received confirmation that my MTY order was filled at just past 10 after 3 p.m., and it looks like the fractional buy offer of $10.95 yielded us 0.1996 shares for an average share price per whole share of $54.84. So I'm going to enter that into the spreadsheet, and I will be right back with the updated portfolio. Okay, so taking a look at the portfolio after investing this month's allotment and after market close on April 1st, the portfolio now holds 16 Morguard shares worth $316.96, making up 76.57% of the portfolio. The second largest holding is still Knight Therapeutics, of which I have 11 shares worth $57.09, and it makes up 13.79% of the portfolio. And last up is the MTY Food Group position, which is now nearing 3/4 of a share, and it is valued at $39.89, comprising the remaining 9.64% of the portfolio, leaving me once again with no cash left over, which is currently the goal of this portfolio. And because this month's episode is a bit on the shorter side, and I know a lot of people do like the security of having a bit of extra capital lying around to take advantage of a great buying opportunity that might come along at an unfavorable time, I'll quickly explain why I do not currently want to hold any cash in the portfolio and why I don't plan on building up a cash position anytime soon. First though, I will say that holding cash in a portfolio does make sense and is definitely a good decision for an investor who has already built up a sizable portfolio relative to their regular contributions. But for someone who's just starting up their investment portfolio, assuming they aren't doing so with some large lump sum from, say, inheritance or something like that, then they're probably going to be able to make regular cash deposits into their investment account that make up a large portion of their total holdings. The monthly portfolio is a perfect example of this, since it's currently worth $413.94 and it doesn't have any cash. But I know that next month I will be depositing an additional $100 of cash into the portfolio, which means that assuming that share prices stay roughly the same, I'll have almost a 20% cash position to invest for next month. If share prices do happen to go up, then I'll be happy that I'm already invested. And if they go down, then that $100 of next month's capital will make up an even larger percentage of the portfolio, which will be ready to invest at the lower prices. Personally, I like to keep a cash position worth 5% or so of any given portfolio, so it wouldn't make much sense for me to start stockpiling cash until my regular contributions start becoming too small to achieve my target cash percentage. Based on the size of my regular deposits compared to the size of my monthly portfolio, this will probably take quite a while. I decided to go ahead and make a quick chart showing how much of the monthly portfolio a $100 contribution would amount to on a month-by-month basis, assuming I was able to achieve my targeted 12% annual return. Based on this list, which is only meant to give a ballpark idea of portfolio and contribution sizing, my investments into the portfolio won't likely hit a range where I'd even consider holding cash until we start getting closer to the 24-month mark. But even then, I'd probably only be able to hold onto the cash for maybe about a month or so before the capital started piling up and surpassing my target range. So realistically, unless I'm struggling to find any reasonable investments in the market, I won't likely start holding onto cash until we get to at least year 4. Though again, this is a pretty generalized chart that completely neglects over or underperformance and especially dividends, which now we can get into because I've talked about my future plans for holding cash in the portfolio extensively enough. So this month, the portfolio received a distribution from 8 shares of Morguard, bringing in 47 cents. And the ex-dividend date was also passed for next month, and at the record date, the account held 12 shares of Morguard that will qualify for April's payout. The distribution per share was not raised over the month, and none of the portfolio's other holdings are expected to pay a dividend in April, so I'm expecting to receive 70 cents in distributions next month, coming solely from Morguard. This distribution will match the total cumulative dividends that the portfolio has been paid in the account so far. Moving to the yield on cost chart, over the next year, if I continue to hold my 16 shares of Morguard, which pay a monthly distribution of 5.83 cents per share, I can expect to earn roughly $11.19 annually for a yield on cost of 3.69%. MTY is also expected to pay me dividends in future months, which should bring in an annual yield of 61 cents on the almost 0.73 shares that are held in the account. The current yield on cost for MTY shares is 1.58%, and when combining this dividend with Morguard's, we have a total expected annual return from distributions of $11.81, since Knight Therapeutics does not pay a dividend. The portfolio's book cost is $400.70, so dividing that by the $11.81 annual yield, the monthly portfolio has a current yield on cost of 2.95%. And with that, I believe that's everything that I have to cover in this month's episode. So please remember that the information presented in this video should not be taken as financial advice and should be used as a starting point for you to do more research into companies that interest you. These videos do not cover anywhere near enough information that is necessary to make good investment decisions on individual securities. I make these videos only to give you inspiration and insight into my personal decisions when investing. I am not a financial advisor, I'm just a Canadian who likes to invest and share my opinions with others. In doing so, I hope that I was able to provide you with some sort of value, and if I did, then please consider sharing it with someone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.